do a little recap of what even happened this week.
Okay,
So,
start with that.
pretty insane week. We had a liquidation cascade in bonds, which that was the most significant thing that happened. We yields hit the Trump ceiling, and that only lasted a day, and then it completely reversed from there. Even equities reversed from there. So there's a lot to talk about on what happened this week, and we should also address what our plans are going forward.
Yeah, so obviously the biggest question right now is what actually is going on in the market, right? Like, what's the trade, as they would say? And quite frankly, I think the fact that the fact that you're having an environment where VIX is pretty much normalizing up in the high 30s is problematic for a lot of things that go beyond just bonds or stock or currency or anything like that. I think when you have VIX normalizing it what we would consider like, back in August we wicked and this was pretty artificial too. This wasn't a whole real candle, but VIX was up in the 30s, right, in August and rolled over. We're staying there now. Like we're not like VIX hasn't been in the 20s since the beginning of the month now.
Yeah, this is
And
very comparable to COVID.
yeah, like if we go back to COVID, we had this situation. Like, let's kill the charts. I mean, DDAP, and let's look back at time. So you can see the difference here, right? Like vol is sitting at levels that when so you had this COVID pop and this fade, and obviously Fed unleashing QE pretty much the entire they brought out the entire tool belt here, and they unloaded all the stimulus and whatever they could possibly do. And vol was able to go down, and then it ended up in a situation where we had inflation starting to break out, and then the Fed needed to start raising interest rates. And then what ended up happening here is we saw equity vol pick up, or VIX pick up, but it didn't really get over 33, 34 area. Like we were in this range and we were just pushing up and down, up and down, up and down. It was pretty much a controlled vol environment. It wasn't too crazy. This is just unhinged at this point. Like we're getting 50 prints. We can't even get below 30. We're just chopping sideways. And I know a lot of this has to do with what happened in the last few days here in the markets, especially around the tariff postponements and whatnot, and that was a big move up, and then almost a circuit breaker down today. So there's a lot of vol in the market, and this inherently is very it becomes very systemic, and it becomes very risk off. And the situation I think that we're in right now is, I mean, even if we look at bond vol, right? Let's just look at bond vol, and we'll go back. We'll zoom out to 2022 as well. Bond vol is pretty much at the 2022 slightly below range, where bonds were just getting liquidated below, right? It was liquidated down. Everyone, go back to TLT, right? Bonds just getting absolutely smoked. So move is up near those levels now. So this is depending on how bonds move. We saw that push in COVID when bonds were ripping, right? Going into COVID, bond vol was rising, but this level of bond vol becomes somewhat problematic if we can break up and continue higher. And I think the Fed's probably watching this. Not saying that they are going to do QE or anything, but they're definitely keeping an eye on volatility, because volatility is a precursor for liquidity, right? Because if volatility is low, that means you have very deep markets, right? So you have markets that catch a lot of traction. When volatility is very high, liquidity conditions fade, right? Because what ends up happening is you don't have that market depth and things start moving very fast. And I think it was yesterday we saw a nearly a whole 1% point premium on the NAV to SPY ETF, right? So the SPY ETF was trading at a 1% premium to the underlying. That's how much buying there was yesterday, which is it's unheard of in recent times. So there's obviously, the volatility does a lot of destructive things beyond just making prices whiplash a lot. And I think that the situation we're in right now, we're in a scenario where vol is very high and almost becomes uninvestable, right? And it bleeds into other markets. We're seeing the dollar move 2 percentage points in a day. Like this is not the and we're seeing like cross rates between US dollar, Swiss franc go haywire, right? These are not like look at the size of these candles versus like how this usually trades. This is
Also,
not
are
normal.
these currency moves, are these signs that countries are now reshoring their currency and possibly selling US bonds?
Yeah, I mean, I think that the issue that you have though is not it's not so bond focused, right? Because bonds do matter, but I would say that 2022, that rate hiking cycle that we saw that drove the dollar pretty much ballistic up like this, right? Was really just a United States market capture of the rest of the world into money market. That's what this was, right? And I don't think anywhere along this way we transferred that money that was sitting in money markets into duration, right? It's not like you were drawing all this money up in here via the rise in the dollar into 3 month or T bills, right? And then they were like, oh yeah, let's pivot that at some point along this curve all into long duration long bonds, and now they're getting liquidated. I don't think that's what happened. I do think that this becomes problematic for FX and just market stability if we start to see like the dollar just continue to fall like the way that it's doing. Remember, it's not so much where the dollar goes or where the market's going. It's just a matter of speed at which it's moving that things become problematic. I mean, we were seeing huge issues with basis trades this week, right? And that was helping accelerate bond breakdowns and yield breakouts that failed and seem to now be at least retrying. We'll see if this fails as well. And these are again the way yields are moving, the way currencies moving, the way stocks are moving. It's so systemic that it becomes basically a crisis style risk off where there is no there are very few things. Gold being a very, very strong outperformer, right? Very, very strong outperformer, especially in the midst of whatever has been going on in the last couple of weeks here. Gold has been winning. Now, there are very few assets that are winning in this type of environment,
And
especially when you have this.
that also just adds issues, that adds more liquidity issues, because now when funds are taking losses, they don't have anything that diversifies them. They're taking losses on everything that they hold. And
Yeah,
that just contributes to liquidity events where they're forced to
like let
sell.
like here's the 60/40, right? The 60/40 is down, I think, roughly 4% for the year. So it's not bad. But given the style of equity move, bonds didn't actually hedge. It was you would have similar returns. You would have found similar returns than by just sitting in cash, or at least very close, right? Because bonds didn't really go anywhere when stocks got smoked. We look at TLT, right? Like TLT is at the same level as it was on January 28th. It's just sideways. Actually, it's pulled back quite significantly and quite quickly in the last 3 or 4 trading sessions, but it it hasn't advanced. And this brings the question about as to why aren't bonds bidding? And there's a lot of different conspiracies out there. One of them being foreign foreign actors trying to manipulate our bond market. But I'm not too sure I believe that, at least all the way. I do think that if we take a look at just the swap spreads, if we try and let's see. So swap spreads took a dive this week. They're a little higher on this chart. This is not an it doesn't look to be an accurate ticker. I'd have to find it. Nonetheless, swap spreads took a dive this week, and they ended up creating a situation where traders were getting margin called, especially in leveraged bonds. And what this ended up doing is it creates this scenario where you have this global or anyone that has this type of basis trade on where they're long a bunch of spot bonds and short futures, and they have to sell the spot bonds, right? All rapidly. And you end up in a situation where you essentially have foreign actors, if they're hedge funds overseas, selling US bonds, but it's not for a very political driven reason. It's because they're getting squeezed, right? And I would guess that there was some sort of liquidity crunch in here, probably from the high vol environments that we've been seeing, that sparked an unwind of that basis trade, and it just compounded on itself until it somewhat exhausted itself to the downside. And that we saw the long end get pretty whacked up over that in the last 4 or 5 trading sessions. And I don't think it's this idea that you have a country trying to break our bond market. I think it's a little bit of everything, right? So the basis trade is something that's one factor. Then you probably have some foreign bond investors in other countries that have a sour taste in their mouth over all these political actions, so they're selling, right? But it's not so much one institution. It's just it's a lot of a little bit of everything all put together that kind of just make this a situation where bonds have seen negative price action in an environment that ultimately you would think that they'd be bidding. Like, when we look at crude oil, where it is, crude has gone from 71 to 60 in this month's time frame, and their bonds are actually lower. Rates are higher, believe it or not. Which
Yeah.
again is quite fascinating given what's going on here. And I kind of summed this up in the chat with the members over the last couple of days. I think I've come to a conclusion here where, like, this is all boiled down to a viability trade of America. This is why, like, as of late, you're seeing dollar dump. You're seeing markets dump. I mean, yeah, they're chopping around here, but like they're down quite a bit over the last month, right? So markets are down, stocks are down, currencies down, bonds are down. Pretty much everything that is dollar denominated and fixed is down. And I think that what is going on is you have like a world consideration, a global consideration of, like, is US going to be in the same position when this is all said and done than they were before it started? And I think that's what's causing a lot of this of the issues. And then now take those issues and those concerns and then amplify it because of the vol in the environment. And I think that's what we're seeing right now, which is why bonds they almost seem broken, right? Bonds seem broken.
Yeah,
It's just the way that they're
they're
trading.
opposites now. I'm starting to think that if America does head into a recession, bonds aren't even going to save them, because they're
No,
implying that if we go into a recession with a 6% deficit, we're going to be at a 10% deficit by the time we get out of that recession. That's what
right.
they're
Yeah.
expecting. And I think that's
Hmm.
one of the big reasons why it's just not working. Even as we see news come out that is recessionary and deflationary, bonds take it negatively.
Yeah. So let's talk about why our systematic strategies use bonds, right? Why do we focus on bonds over gold? Because this is probably everyone's like wondering. Um, this is obviously the clear winner. There's like no doubt that gold is the winner of this of this regime, of this specific regime. Gold is the winner, and bonds are so far a very, very polar opposite of what gold is, which gives me the indication again that it is essentially a viability trade. You're basically putting on the typical long gold short bonds trade where you're betting that the United States will be in a worse fiscal and global position when this is all said and done than when they started. That's what this is telling me. And I think that that's what the market is concerned about right now, which is why vol is maintaining its elevated bid. And then also on top of that, right, we have headlines coming out literally this news cycle has gone from weekly to monthly things to literally every day there's something new happening. And that is also not conducive for risk assets or risk in general, right? Um, all in all, I think that the bonds right now are in a position where rates can reverse easily. This is the situation. This is what you have to also understand, that rates start going up here. I mean, the government's quite. If the government cares, does the government care about defending 5% on the 30 year? Is that something they care about? Do they care about defending 4.5% on the 10 year? Are these things that they care about? And so far, it seems, now this just might be a confusion of correlations because we saw the way that as soon as the bond yield started skipping, I think it was it Tuesday night, early Wednesday morning, Trump comes out and reverses the tariff plan within 12 hours. It was like 12 or 13 hours after deployment. The tariff plan was walked back, and he was quoted that mentioning basically reporters have quoted him mentioning the bond market. So they're obviously looking at this, and I would say that maybe these moves weren't 100% the driver of them, but at least now there's some anticipation that maybe the government will defend these levels, and that's probably like if you're looking at bonds right now, that is probably one of the riskier segments I would guess because like rates can reverse if most of this is like basis driven and the basis trade can really just cool itself down and really retrace back to where we were, December, February, -80. I think that as of right now, this is in the -88s and -92s. It's not quite -93, but it's down there. And if that reverses, I think that will relieve some stress from rates. But at the same time, you've kind of you had the president, you had basically the administration's cards thrown out on the table the other night, and does the market want to basically play peekaboo with the or does the market want to play peekaboo with the government, right? Like how far up can they, like at what point becomes the maximum threshold where the government has to react, and what does the government react with? you know these are quite funny enough, like where Scott Bessent is now the Treasury Secretary, and he was assisting Soros back in the day, right? With Druckenmiller. I think that that type of trade where people can break the Bank of England in that scenario, when you start getting these defensive levels that the market perceives as lines in the sand, things may start getting tested. Now, this is not a crisis talk or anything like that, but this is something very simple to the point where, like, if the market figures out where a pain point is, at some point it may try to test those waters again. And I hope we don't. I mean, I hope bonds can reverse off, rates can reverse off these levels and provide some sort of safe haven in this environment. But right now they're not. So that's something to keep an eye on. And if they really start accelerating higher, I don't think that I think we're gonna have some problems, I should say the least, because the higher rates go, the more problematic they become for equities. Because again, if you look at equities from an earnings yield perspective, the higher rates go, and the faster they rise, as long as you're making a bet that the government's not going to default, you end up having a situation where you get paid substantially more to just hold bonds than you will annualize in the market at some point, right? And I think, especially if you adjust it for a risk-free basis, right? And the fact that the government's not going to default, even with inflation. I mean, we look at inflation swaps in America, right? 30-year inflation swaps. They're nowhere near levels that we saw in 2008. The highs of those eras. They're not even at the highs of 2022. Inflation swaps are much lower. So this is like a mix of uncertainty and just volatility. I think there's a bunch of things driving rates up, and if they keep going up, I think they will continue to suck capital out of equities and into fixed income, even if it's at the front of the curve, and then they move it out to duration. Because again, the higher equities go, the higher rates go, the less interesting equities are, right? And I think
Yeah.
that's the dilemma we're facing right now, especially with vol where it is. If vol was a lot lower, I don't think we'd be having half these issues that we were having. And one could say, look, maybe the administration needs to dampen down the headlines and they could resolve a lot of this damage, but they're going to do what they're going to do. So we have
Yeah.
to just deal and trade with whatever they give us.
The thing that has me concerned is how hawkish the Fed still is. And they're treating these higher inflation expectations from tariffs the same as they did during the last inflation spike we had, the real inflation that was induced by money printing. They're treating this the same way. They're going to hold rates because of this tariff induced inflation, but it's very different when it's tariff induced versus being induced by an increase in the money supply. Because with the increase in the money supply, you have consumers that have more money and they're able to afford these higher prices and drive prices higher. But when you have this tariff, no one has money left. Everyone's broke and you get these higher prices. No one's going to be able to afford them. There's going to be a way bigger growth shock than what we saw during that stagflationary period in 2022.
Oh yeah, absolutely. And I mean, the Fed right now, going out to their cycle low, which looks to be pretty much um, December 2026, around that area, is lower. I mean, higher. Their policy floor is higher on across the cutting cycle than it was last summer in the labor scare, and it was in 2024, end of 2023, when we had the Powell pivot, when the Fed was. It looked like the Fed was going to massively well, basically they dropped their cards for interest rate cuts, and the bond market ate that up, and we're tighter than both of those periods right now on a forward basis, which means the Fed is very, very hawkish. And the reason for this is there's a lot. It's just, remember, a lot of this stems from vol itself. The higher vol is, and I'm not talking about just equity volatility, I'm talking about political volatility, right? The higher the vol is in the environment, volatility of everything, right? The more uncertainty there is. And the more uncertainty there is, the Fed does not want to be in a position where they have to cut interest rates significantly and have to then re-hike them. Because remember, this is a big problem here now. If the government, and this is probably why long end is reacting in such a specific way at the moment. If you're running a 6% fiscal deficit, okay? Let's just say you're already at negative, you're at 6%. And you hit the recession button, you're going to like probably 10, right? Something of the sorts. Okay. Now, if you believe that the Fed has controlled inflation up to date by basically keeping policy at a level that is above the rate of inflation and above the persistent pressure of um, and the output gap, of which excess is bleeding into the economy above its potential due to the high deficit, right? If you believe the Fed is sufficiently restrictive, what happens if that deficit goes up? The Fed is going to have to then become more restrictive than they are already, because the deficit will then add to inflationary pressures. Even though, yes, you're going to have that deflationary impact up front, right? But that inflationary that follow-up inflationary issue is more problematic, because the Fed has to see, the Fed, it becomes a game of war. The Fed has to at least monetary war. The Fed has to raise interest rates to offset that huge fiscal deficit, which will undoubtedly, spark the put a fire under the economy and light things up. But at the same time, by them pushing rates higher to offset that inflation, they're going to be, ramping up the net interest expense on the government debt that the government has to pay. So it becomes a war now. The Fed has to ramp up the interest rate, right, to offset that fiscal deficit. But then that fiscal deficit is going to get even worse, because the sensitivity of rates into the excuse me, to the deficit due to interest rate expenses are going to basically be multiplied higher. And that's the problem here. I think that's why the bond market's kind of stale. And the reason for that is because the market kind of got blindsided here into the situation where you're having a domestic inflation, you're basically having a domestic deflationary force, which is, we're seeing this with um, tariffs and whatnot, right? How they're going to basically shut down trade, and it's very deflationary over the long run. But it's not something that the rest of the world has to adhere to. It's isolated largely into America, right? Because Europe is going to try and strike every deal possible to do trade. Now, U.S. can have some influence on Europe's trade for sure, right? But if it truly ices itself out, what ends up happening is the rest of the world will figure out a way to function to some degree, while America no longer is the dominant consumer of the world. And that, I think, is sounds like so much, but that's I think the noise that's going on in the market right now between stocks, bonds, currency, and volatility itself.
Yeah. And I don't really see a way out of it. anytime soon, honestly. I think this deficit problem is just going to keep looming. Like, even if they do lower the deficit, then comes a recession, then what? The deficit's still a problem throughout all of that.
See, the situation. So there is an equilibrium at where the Fed can hold policy rate and neutralize a deficit, neutralize inflation from the deficit. You're not neutralizing. You're basically offsetting, disproportionately offsetting inflationary effects from the deficit. But growth is still able to be churned out for some time, and then I think eventually growth does get hit in the process, which is why you were able to see us have these real positive GDP growth environments the last couple of years with this deficit so high, because the Fed never actually committed to the cutting cycle. They cut, what was it, 100 basis points roughly? Yeah, roughly 100. Yeah, 100 basis points, right? And they stopped. And I think that if they would have gone any further, what would happen is they open up the risk of allowing that deficit driven inflation to seep back into the economy. Because if you look at the inflation rate, a large part of this is fiscal driven. Like inflation at, it's 2.4%. This is great, right? Great news. It will drop, right? It'll drop, and it might be because you're shutting down trade. But if the Fed easing, they can't ease too much with the deficit where it is, because you widen that barrier. If the deficit was at 3%, the Fed could go much lower than theoretically 3%,
Yeah,
right?
they risk too much if they lower it. They risk that deficit sparking more inflation.
Right. So this is the dilemma. This is why Trump has, that the administration needs to handle a deficit at some point. If they don't, there's a possibility, it's not guaranteed, there's a possibility that going forward, bonds won't have that asymmetrical recession payoff where you can catch a fat trend and really ride them quite long, because the Fed won't be able to move policy the way it used to. And we have to see how that progresses. But, like, again, just look at the market, right? Again, very systemic issues going on, a lot of systemic issues at the moment, but inflation's in at 2.4%. We're pretty much at the September low, August low, right? Great. I mean, we're 40 basis points away from, if we look at, okay, 2.42 for April as of right now. Okay. 2.42. Well, basically the same print for April. So next month's print's going to be the same. So the Fed's gotten inflation, or the administration's gotten inflation back down to where it was in the late summer of last year. The problem is I think that the circumstances that they brought inflation down wasn't in the same manner that it's been coming down this entire time. Like, this wasn't the, oh, disinflation's continuing type of thing. Okay, this was something, you had this buildup of inflationary pressures, front running, all this noise, right? But you roll that over, and now you have this situation where commodities don't look good, right? Like, look at commodities; they're 20. This is where we were in March. The last day of March was here. Commodities have pretty much done, like, if you look at commodities from a range basis, from where they've been, commodities went from the upper end of their range to the lower end of their range in like 7 trading days or something like that. You can even look at the chart. Not less. In 3 trading days, they fell this much. So this is obviously very disinflationary. And at some point, if this keeps going deflationary, and I think that's the issue that we're looking at right now with the government, we're in a position where bonds are taking the brute force of it. Now, there's a lot of things that could be done here to resolve this issue. Like, the Fed could step in and create a facility to offload a lot of the stress on the long end. They can do regulation reform to allow banks to purchase more of the long end. There's a lot of things that they can do, but we have yet to see those things. And I think that you're seeing more of a systemic shock here than anything else. And until we get some clarity as to what the administration is going to end up finalizing their trade deals with, when, how long, I think that at that point, bonds will likely show a clear picture. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website at market-radar.com. All right.